Do you use the PE ratio in your investing analysis? I certainly do. The PE ratio is probably the most used metric in investing. If you watch any type of financial news like CNBC, you'll see the PE ratio being used quite often. The reason for it is that it's easy to understand. It's the price of a share divided by the earnings per share. And as the earnings per share gets larger, it makes the overall PE ratio lower. So an investor is looking for a low PE ratio for a good company. What makes a good company? Well, that's a big question. And I analyze in a process. If you watch my videos, you understand my process, how I look at companies, how I value them, and how I put them into a grouping, into a quadrant of most desirable types of companies and the least desirable types of companies. I'm going to cover in this video how I use the PE ratio and how I put companies in a particular category, and then expect and apply a particular PE ratio to those companies. As I do in every video, let me remind you that I'm an individual investor sharing my experience and journey as an investor. I'm not providing any financial advice. I don't recommend you buy, sell, or invest in any way, any of the companies that I'm going to talk about. I'm also sponsored by Moomoo, which is a brokerage, and they offer new account holders a pretty good offer. They'll pay 8.1% on cash, which is really nice. They'll also give you 15 free stocks if you deposit more than $1,000. If you're interested in that offer, I'll put details in the description of the video. So what are the most desirable companies? What PE ratio should we pay for those companies? And if you haven't watched my video where I covered competitive moats, I encourage you to do so, because this is really using my PE ratio method is kind of a building on top of that particular lesson. And here I've put the companies that I find most desirable in the green quadrant. These are companies with really strong competitive moats. So they don't have a lot of competition. They make a lot of money and they're growing. You have companies in the gray quadrants that are good companies, but their growth has really slowed down. And those companies are moderately desirable. And then in the red are companies that I feel are undesirable. They have very weak competitive moats. They are pretty much on their way of being replaced or maybe going bankrupt. And those companies I try to really stay away from. Now, in using PE ratios, I want to go through each quadrant and put an expectation of a range of PEs that I would expect in each quadrant and I would be using as I look at a company. So we have the quadrant with the most desirable companies, and then the quadrant with the least desirable companies, and then companies that are in between the two. And the most desirable companies, in my opinion, you'll see PE ratios above 18 and up to 100, if not more. These are really strong companies that have strong competitive moats. The companies are really desired by the market. The market's willing to pay a very high PE ratio. I'm willing to pay a high PE ratio if I'm seeing a few things. One is they're growing, and they'll probably grow their revenues and grow their overall profitability substantially in the coming years. And when they do so, that portion of the formula will drive the PE ratio down. So maybe a high growth company that's at near 100 PE today might be closer to 25 in 2 years, because if they grow, they're just going to become bigger and have better metrics when it comes to the PE ratio. Companies in the gray, these are companies that I still find investable, but these companies should have a PE ratio between 9 and 18, a very rational PE ratio. These businesses tend to be mature businesses. They're not growing a whole lot, but they tend to be profitable. They tend to pay dividends. And these companies tend to be very stable, very predictable. And these companies, I expect the PE ratio between 9 and 18. Then there's the undesirable zone. And again, I don't like investing in the undesirable zone, because these companies, they don't have a long-term future. They tend to be quite weak. They don't have a barrier of entry into their market. Maybe their market's being disrupted and is no longer going to be needed in the future. That's just a bad place to invest. And PE ratios there should be under 10. There might be one or two that are near that number of 10, but companies that are really put into this quadrant, for me, are uninvestable and I try to stay away from. Let me go over some examples, starting with the desirable zone. We all know Microsoft, and Microsoft has a current PE ratio of 40.48. And that PE ratio, I think, is very defendable. Microsoft's a growing company. They are really good in all areas of their business. NVIDIA is a really hot company. They have a current PE ratio of 73.63. And investors likely feel that NVIDIA is going to get bigger. They're going to make more money. And eventually, they're going to drive down that PE ratio into maybe the 20s. And that's why they continue to buy that stock. Eli Lilly is probably the most successful pharmaceutical company in the recent years, and their PE ratio is way up there, 134.69. This is another case where, as the company gets larger, makes more money, they're going to bring that PE ratio down. But for now, they're really in demand in the market. People really like their stock. Part of the reason why these PE ratios are so high is stock prices have gone really high. And that stock price is driven by the market's enthusiasm and confidence that these businesses are going to be worth a lot of money. The last example in the green is Amazon. And boy, Amazon does a lot of things right. And that business has a PE ratio of 55.87. Again, as Amazon matures, that PE ratio will likely drop. Looking in the two gray quadrants, businesses like CBS have a really nice low PE ratio of 9.93. CBS continues to grow, but the market is really discounting healthcare companies this year for some reason. And this company has a good low PE ratio. Hewlett Packard, this is the Hewlett Packard for consumer products like laptop computers. They have a nice low PE ratio of 11.7. They also pay a nice dividend. PayPal, their stock has really come down over the last 3 years. And as their stock prices come down, their PE ratio has really dropped as well. Comcast is a mature business in media and entertainment, and their PE ratio is only 10. This is a dividend payer that has some growth, moderate growth. They're not breaking any records, but they are large already and continue to grow. Then we have Allstate, which I'm using their future PE because their future PE shows 11.73. Their current PE is really high because they had an unprofitable quarter at the beginning of the year. But overall, the companies in gray have PE ratios that are much lower than those high growth companies and are good investing ideas if you're looking for income or a nice stable stock that's going to be in the portfolio producing good appreciation and good income. And the last quadrant is the red quadrant, which is the place that I don't like to invest. And the three companies I wanted to show is first GameStop. Boy, this business is on its way out. And, gamers are buying online, they're streaming online, they're downloading online, not sure what GameStop's going to do and what products they're going to sell. But that business is really on the ropes. Their PE is sky high, 345. And it's all this hype over the Roaring Kitty post, which is a little crazy. I don't invest because there's a famous person that is texting or posting on a particular stock. I mean, the people that understand that, knock yourselves out. I don't, and I don't invest in GameStop. Next one is Macy's. So Macy's profitability has dropped so much that their PE ratio is sky high at 491. And this is the retail space where it's constantly under threat from online threats like Amazon or Alibaba. I mean, where will Macy's be in 10 years? I'm not sure, but I'm not sure they're going to be around. So that's why I put Macy's in the red zone. It's really shocking how high their PE ratio is. I want the PE ratio in the red zone to be way under 10. And in these two cases, they're way above 10, showing there's something wrong with these valuations on these two companies. And the last one is Gray, which is a television company. And I don't need to tell anybody that television's on its way out. Streaming is pretty much what people want to do. And in this case here, their forward PE is only 1.36. So that shows that investors just do not have any confidence in the television broadcasting business. I don't blame them. The makers of typewriters, which completely were disrupted by computers, and other industries are examples of where I think the television industry is going to end up, which is really not relevant, continue to just become smaller and smaller over time. So those are examples of different PE ratios based on the desirability of a company. And as I look at companies, I really first I buy into the company. I want to understand the business. I want to put them in one of these quadrants. Are they in the green? And this is just going to be a growing company, really bright future. Are they in the gray and are worth considering as an investment, but I don't expect it to double or triple in the next 5 years? Or they're in the red, which is uninvestable. I first really want to make that decision and then start using the PE ratio to understand where's this business going? And if you've watched my videos, I do value companies based on earnings per share. And I use the PE ratio as part of the formula to see what this business is worth or a particular business is worth. Most analysts, where you see an analyst report, they use earnings per share. And part of their formula is using the PE ratio. The decision an investor needs to make is, what PE ratio am I willing to make or to use in making that investment? So our decision is, what am I willing to pay for that business? Where do I rank that business in the scheme of all the businesses that are available for me to buy shares in? Just remember, you have choices in the marketplace, thousands of companies, from exciting companies like Microsoft to really dull companies like Union Pacific. You get the choice of which company to invest in, and you get the choice of using the metrics that you believe ought to be used as you deploy your capital, your hard-earned money, and you get that return on investment. So that's my video on using the PE ratio, how I use it, how I apply it, and how I put it into an overall process as I use that process to analyze, investigate, and invest in quality companies. I hope you enjoyed the video, and I really appreciate you watching.